My name is Matthew Vass. I'm Channel Director at Mantis, and we supply multi-camera solutions integrated with my Geotab. I've spent the last nearly a decade now working in fleet technology, cameras and telematics and other fleet technology systems. And whenever I'm talking to customers, there's still one question that they ask me that just makes my heart sink every single time. And it's, if I buy telematics or cameras, will my insurance premiums go down? I'd love to say yes, just straight out of the box. But the answer is, it can do, but you're going to have to do some work. We'll do our bit, but ultimately you have to do some heavy lifting as well as an actual fleet operator with the data. And that's a little bit what inspired me kind of get into this topic and start really looking into insurers. You know, I'm essentially telling my customers that they have to get off their ass and do some work. So I thought maybe I should get off my ass and actually do some research and actually work out how I can help them beyond just selling them the kit. How can we be more consultative, and how can we help customers actually get the return on investment around insurance? So in this session, we're actually going to look at some practical advice around the loss ratio topic. What it is, why it matters, how you can successfully impact it with your fleet data, using some practical examples that we've come up with. And at the end of it, I'm going to give you the opportunity to download a document that I've created called the Loss Ratio Playbook, which is a step-by-step guide to using camera telematics to manage your loss ratio better. So why does it matter? Despite the fact that people are spending and investing more money in camera, telematics, and fleet technologies, premiums are still going up. If it was working and being effective, surely it should be going down the other way. You know, it's 65% increases in 10 years. You know, 2025, we're seeing 7 to 9% spikes in insurance across the board. Some fleets are seeing double-digit insurance premiums increase year on year. When we actually look at combined operating ratios from the insurers, this sits above the loss ratio. They're seeing 105, 115% operating ratios, which means that they're not profitable because fleets are at risk and it's too high. And even the advent of fraud rising in states like Florida, Texas, California, Georgia, and rising litigation. Lawyers and legal companies, they're spending billions on advertising every single year to try and sue you or try and get people to sue you or do something with your vehicles, your big, beautiful branded vehicles with your employee in there. They're trying to find a reason to take your money off you. And even vehicle repair costs going up 30, 40%, potentially more increases. So costs are just going up across the board. And then, of course, there's a topic of nuclear verdicts. Neil mentioned it in his keynote speech, I believe, yesterday. Gone up 1,000% since 2010. Median verdicts at £44 million now. That's doubled in the last decade. And 70% of large claims now are actually settled out of court because the fleet operators, the insurers, don't want a risk of going to a jury verdict, especially when liability is in doubt for any particular reason. So some pretty scary numbers there as to why it actually matters and why you should be looking at this. And it's such an important thing. I ask fleet operators, do you know what your loss ratio is? And absolutely, some will. Some will not have a clue. Some will know the number but have no idea how to impact it. But it really is a key metric for your future success. And for insurers, it's the number that tells your risk story. So just in case anyone doesn't know and isn't aware, what is the loss ratio? Well, loss ratio is simply the claims paid out by the insurer, expenses, the cost of your claims for your fleet for the entire year, divided by your dividends, the amount of money that they've paid into you. And that gives you a percentage that is your loss ratio. So a loss ratio at 105%. For example, if you pay, for every $1 in dividends you pay the insurer is actually paying out $1.05. So essentially, they're paying out more than they're actually being paid in. And that's the situation that insurers don't want to be in. That's a non-profitable customer, and that's where you're incredibly high risk, and that's where you'll get these heavy premium increases. So what does a good look like on a loss ratio? What's a 60%? What's a 40%? What's a 50%? What's a 100%? You know, give me some guidance. I'd love to say there's an industry standard, but there isn't. Fortunately, though, for the last year, I've been talking with insurers, claims handlers, brokers, technologists, and just to give a bit of a guide, give me something I can go back to my customers and say, what does good look like in a loss ratio? And although there's no industry standard, this is a starting point to sort of steer you in the right direction. So if your loss ratio is above 40%, you're a medium risk fleet. Not too bad. And actually, that's where you're looking at stability. Being medium risk is not terrible. It means that you're potentially not going to have big in premium increases. So stability in your premiums is just as valuable as trying to reduce your premiums. As soon as you go over 60%, you're in high-risk fleet. And this puts you in the ballpark of potential increases in your premiums year on year. And obviously, the further north you are, 60%, it could be 5, it could be 10, it could be 15% increases, which can severely impact the bottom line of your business. And 100%, boom, you are uninsurable. You are making the insurer no money at all. Now you're unprofitable. This is putting you in a terrible position. It means you're going to get huge increases in premiums. But even if you go to market with that kind of figure as a historic, people ain't going to want to touch you, or they just want to go charge you a lot more. So you're in a really poor negotiating position. So this is where you definitely don't want to be. But you're getting to 40% and below. This is where you're in the low-risk category. The insurer is making good money from you as an operator, and you are doing that because you're having fewer collisions and fewer claims that's impacting loss ratio. And the good news about this figure is, even if your insurer doesn't agree or doesn't work with you to reduce premiums, it means you can go to market, and with a good history like that, you're going to be a customer people are going to want to have on board. You're going to have access to a greater variety of insurance products and potentially get a better deal. So that's just a bit of a guide where you want to be. So Matthew, that's great. Loss ratio, I'm on board. How the heck do I influence it? What do I do? The great thing is we're in a whole conference with technology and partners and people that provide you fleet data. There is not a problem with fleet data. There is more than enough data now to go around. Everyone's got data coming out of their ears. It's what you actually physically do with that data. And larger fleets that have got the resources and the capability to actually manage that data, fantastic, but a lot of people don't. Time, I always say, is the biggest killer in this industry. Nobody's got time to do anything. We know we should be sitting down and analyzing driver behavior, but we don't have the time to do it. And sometimes people don't understand or realize where's the best places to start with all this data coming at them. So what I've done, and this is going to be a big part of the loss ratio playbook, I've broken this into 3 kind of levers that you can, or pillars, columns, whatever you want to call them, that you guys can focus on with real practical advice for each one about how you can influence that loss ratio figure. Preventing collisions is an obvious one. If you want to reduce how much claims you're paying out, you have fewer collisions. That's fine. So that's the one really, everyone's hyper-focused on that. Geotab and the guys here doing great work on risk analytics and all that kind of good stuff. That's the one people really, really understand and understand the benefit of. But there's a couple more. There's also the protect. And particularly with the advent of multi-camera systems, this is basically stopping any of those non-fault, 50-50 fraudulent claims. Having visibility around the vehicle, it means anyone trying to do something untoward, fraudulent, or try and claim that your vehicle or driver did something they didn't, you can provide unrefutable evidence and tell them to go away. So none of that cost hits your bottom line in your insurance. And the third one is actually, if you have a claim, which you inevitably will, it doesn't matter whether it's your own fault or non-fault, the faster you deal with that claim and close that claim, the cheaper the overall cost. And as I said, it's the cost per claim that's impacting your loss ratio. I literally did an analysis for a company back in the UK, 200 vans, construction, and the average time to report a collision was 8 days. And they actually shared me a note from their insurance company screaming at them, saying, you need to get to 80% of your collisions reported within 24 hours, or we're going to have a problem. So they were screaming at them to do this, and there's technology out there that will help you do this. So prevent. Every crash tells a story. AI's gone crazy. There's a million different AI analytics for driver behavior and all these different telematics things for driver behavior. There are basically 3 things that really influence bad driving. Speeding or driving too fast for the conditions, distraction or inattention, or driving while tired or fatigued. If you get control of those 3 things, it will have a massive impact on your fleet, on your loss ratio, on your bottom line. But remember, data without action equals no ROI. It's not an energy-saving light bulb. You don't just plug this technology in and boom, you save money. You have to work at it. You have to use the data. You have to implement it into your business. And particularly with the cameras, you need to turn to allies. And again, multi-camera is great for this. So, and in the cab, constantly just spying, analyzing the drivers, saying, oh, they're on the phone and all that. It's really negative. But actually, again, with the multi-camera, it's an aid for the driver. It's giving them greater visibility. It removes the I didn't see this moments, the reversing into poles, reversing into trees, all that bodywork damage that goes into it. And just by having that, the drivers are more engaged because they see cameras in particular as more of an asset. So that results in more engagement, fewer crashes, and fewer claims. So let's have a look at how prevent actually works out in sort of some numbers and figures. Hopefully you can read that okay. Yeah. So let's take an example fleet, 250 construction fleet. Got telematics, they've popped the AI camera systems in. Before the implementation, they're having 50 at-fault collisions per year. The average cost of those is $25,000 per claim. It could be a lot higher than that, but let's say average. So that's 1.25 million in claims coming off your loss ratio, towards your loss ratio figure. That's going to have a huge impact. And then say this fleet has a loss ratio of 62%. So that's before implementation of cameras and telematics. When it's been properly implemented, and again, my guidebook will help and give you some practical advice for this, you can actually focus on identifying just the 20% of your riskiest drivers. It doesn't need to be every driver you need to look at. It can even be your top 5 or 10%, but certainly your top 20% risky drivers. Using the technology for the in-cab driver coaching, and again, leveraging the multi-cameras to remove all of those visibility issued or collisions. And the result is reducing your at-fault collisions by 20%, reducing your low-speed incidents by 35%, and the claims cost is dropping from 1.25 million down to 950,000. It's 300,000 pounds in insurance-based costs saved every year that will impact your loss ratio. And that could drop your loss ratio down from 62% down to 47%. So we've gone from high to medium risk. And what that can do is prevent you from getting a 10 or 15% increase on your premium next year. And that's what you have to remember. If you do nothing, my current loss ratio means I'm going to get an increase, which could be, 3 years, 1.5 million pounds extra in insurance payments, on that side. So you have to remember, stability is just as key. Stopping and premiums increasing is just as valuable as decreasing them as well. So these are the costs. This is where the money comes in investing in these systems. Let's have a look at protect against fraud. No blame should equal no claim 100% of the time. You've got the technology to have complete visibility in your vehicle. It should make your truth visible. There should be no he said, she said, litigation, going back and forth. It should be, nope, there's my cameras, technology, didn't happen, go away. Save you time and money. So again, let's take a regional operating trucking fleet, 150 vehicles. Let's say they've had 2 non-fault side swipes. Let's say they've had 1 cash for crash or false or fraudulent rear-end collision. And let's say they've also had an alleged property damage. Someone you've damaged my wall or my gate or something like that to a total of $15,000. So all 4 claims would come straight off your insurance policy, even though they're not your fault. Or you've had to fight them out in court or take a load of your time off. Either way you do it, it's going to cost you a load of time, effort, and money. And the fleet was cast as high risk on the back of this. Again, just simply putting full visibility cameras in, it means all of those claims, the side swipes, the non-faults, proven not your faults. The fraudulent, rear-ended claim, again, before the lawyers or anything like that can get involved, say, sorry, your client is lying, go away. And even the property damage claim, again, sorry, Mr. Customer or person, we didn't damage your property, again, settled and done. That's a huge amount of money coming off that. And that can reduce your loss ratio just on those 4 pieces by 17 points, and again, taking you from high to medium risk. And that's, again, eventually, potentially avoiding premiums increases of $220,000 a year. And again, you expand that over 3 years. So you can see a lot of money can be taken off the claims for your insurance relatively easily just by having and utilizing the correct technology. And then I said the third one, the one that people are lesser known, the accelerated claims resolution. As I said, when claims drag on, that's when the lawyers or the body shops and then the other insurance providers, they rub their hands together and say, thank you very much, it's payday. They all feed on delay. They want you to take longer because they can charge you more. They can charge your customer more. And early access to the video, the point of truth, that's what's going to give you the fast resolution around this. And these are some real-world figures about accelerated claims resolution. This is the difference it can make to costs across the board. So, 53% reduction in investigation costs, 18% reduction in legal fees, 25% win rate against disputed claims, 25% reduction in operational expenses. You all know how much you're paying insurance providers per year, so you can translate these numbers into some pretty hefty savings. Again, just on the one lever of accelerating and making sure the claims are being settled quickly with as much less disruption and liability as possible. And again, let's have a look at examples. So 1 collision and 2 outcomes. So a 200 vehicle delivery fleet had a side impact involving a tractor and trailer. and with a passenger car, and of course, this is where liability is disputed. This is where the lawyers get involved. This is where I'm going to sue you. This is where you've got huge costs spiraling out of controls in credit hire vehicles, in bodyworks from third-party or unauthorized garages, or just general legal fees coming out the wazoo before you even get into personal injury, which of course is that's when you get nuclear verdicts. As soon as personal injury comes in, that's when the cost just absolutely skyrockets through the roof. So let's say this claim dragged on for 11 months, just a side swipe, from a passenger car. 11 months to deal with this claim could rack up costs in the $250,000. And this breaks down some examples of where that cost is coming from. Having a hire vehicle, it could be $15,000 to pay them. 120 grand plus just in legal expenses before you even get into personal injury. The storage fees, it just all builds up into the repair cost as well. And that's where the money and the cost comes from, the delays in the claim. So let's say we actually flip that around. So instead of being 11 months, let's say you had the data and this process is in place that you could settle that claim within 30 days, even if it's your own fault, okay? Or whatever it may be. But that could take a cost down from $250,000 to $40,000 just by your insurer getting control of the cost claim cycle. If you've done something own fault and it is your fault, and the third party gets to their insurer first, they're going to put you in some really, really pricey, put them in some really pricey vehicles and some really pricey repair centers. So your insurer getting control of the claim quicker, regardless of own fault or non-fault, will help massively drag these costs down, which again, dramatically impacts that loss ratio figure. So the results, again, just on accelerated claims, $210,000 of claims costs saved, loss ratio reduced by 14 points, and this is the big one. So if you do this and set a plan with your insurance companies, they will begin recognizing you. You're a fleet that takes this seriously. You're a fleet that want to get control of your risk, and we want to invest in fleets that do that. You've taken your reporting down from 8 days down to within 24 hours. This is what they want to see. They want to see fleets with a plan. They want to see fleets with progress. They want to see fleets actively using this technology to the benefit of everyone in partnership with the insurance company. And again, just by that one section, could prevent a 12% increase in premiums on that side. So there's three really, really key ways in which you can actively reduce the amount your insurer is paying out, actively improve your loss ratio, which will improve your relationship with your existing insurer for potential reductions or at least some premium stability. Or if they won't work with you, you can go to market in a much stronger negotiating position. And that is worth its weight in gold. You talk to any insurer out there, you come to them with a good loss ratio figure, they're going to want to work with you. They're going to want to incentivize you. They're going to give you a good deal. And as promised, like I say, there's a lot more to this. I can't fit it all into a 20-minute presentation. But like I say, I have created this guidebook, the Loss Ratio Playbook. So you can go up there and scan the QR code to download your free copy of that. And like I say, I've had this validated by insurers and everything like that. There's a lot more complexity that sits behind it. It's not the be-all and end-all, but it's a great starting place for any fleet operator for saying, right, I've got all this data, I know what I want to achieve, I'm limited on time, I might not have the expertise, but what is it I can focus on? How is it that I can have the biggest impact on the insurance side of things? And that's what the guide will actually take you through in a lot more detail, and there's even a little 10-step plan on the back there as well. So really to summarize, it's a really important topic. It's really important that fleets do understand this figure and where it comes from and how it's impacting. But it's also really important to stop in seeing insurers as the bad guys. It's really easy to say, oh my God, they're constantly putting my premiums up every single year. It's a nightmare. I have to keep changing. I have to keep going to market. Start thinking of them as a partner. They've got to be there. You've got to have the insurance. Work with them to improve. Work with them to see a plan. They don't want to see that you've bought telematics and cameras. They want to see that you have a plan on how to use it. And that's where the pressure comes back onto us as suppliers. We need to be better at not just selling, but actually, like I'm hopefully doing today, giving you guys practical advice on how to implement and actually make this technology effective to get the ROI you were promised at in all the fancy marketing collateral. It's so easy for someone to say, oh, hey, install this and you can reduce premiums by 20%. If they don't tell you how, it's pretty much useless. It's just chatter. It's just marketing noise from that side of things. So like I say, that's a whistle-stop through loss ratio. I hope you enjoyed it. 30 seconds, not too bad on timing there. So yeah, I suppose we can open up for some questions.
First question, are you using dividend to mean premium in the loss ratio formula?
Correct, yes. Yes, so basically what you're paying then, dividend premium, yeah, whichever it is, yes.
How does cargo theft affect loss ratio?
I suppose it depends on the level of coverage you've got and whether cargo theft's included in that. And again, this is where multi-camera comes into it. Having those load cameras, we've seen it loads back in the UK and we're seeing it more in the US, having not just the outside but the inside of the vehicle monitored and just being able to say, what did happen? If the load's got, if it's been nicked, it's been nicked. Sometimes you can't do it, but what you can do is can say, well, it was nicked because the door was left open. It was stolen at this time of night. It was in this vulnerable area. It will give you details that will help you improve your safety protocols to reduce load theft, as well as provide evidence to the police to hopefully catch them as well.
What could be a key to get a better loss ratio if you do not have telematics and you cannot do an RFP because the insurance company does not want to take your risk?
Good question. So telematics is one part. You can just do it with cameras. You can just do it with telematics. They work best if it's actually both. It's going to be tricky without the use of technology to a certain degree. You can chat with your insurers, but they will want some sort of monitoring in the vehicle of some description. Now, it doesn't mean you have to go all singing, all dancing. He's like, there's a lot of data out there, and everyone's just like, buy more data, more features, more features. Again, refer to those things that I looked at right at the start. There are just 3 simple things you need to look at: speeding, anticipation, distraction. If you get control, have some sort of basic technology that does those 3 things and monitored and applied well, will make a difference.